Imagine it is 2026. You are 44 years old, sitting in your car outside an office building somewhere in suburban America. You have worked for more than 2 decades. Your salary is higher than ever. Your title is better. You own a home, have a retirement account, and did almost everything a successful professional was supposed to do. Yet, when you calculate what you actually own, the number feels strangely small. Somewhere between the promotions, raises, job changes, and benefits packages, something disappeared. Not your income, your wealth. And some of the career decisions that looked smartest at the time may be exactly where it went. That distinction is the key to everything that follows. Income is what the labor market pays you today. Net worth is what survives after decades of taxes, debt, spending, benefits, fees, and compounding. The modern employment system increasingly leaves that conversion in the worker's hands. This isn't theory. It is documented in how the labor market itself has changed. In January 2024, median employee tenure in the United States had fallen to 3.9 years, the lowest level since January 2002. The employment bargain changed. Many assumptions workers carried into it did not. The first decision is perhaps the most socially acceptable of all: staying loyal too long. For much of the 20th century, loyalty could be economically rational. A worker entered a company, accumulated seniority, received predictable raises, and in many industries, eventually collected a defined benefit pension. The longer the relationship lasted, the more valuable it could become. The employer carried much of the retirement risk. Then the architecture changed. Beginning in the late 20th century, defined. Contribution plans increasingly displaced traditional pensions. Retirement became less of a promise from an institution and more of an account attached to an individual. Yet the cultural expectation of loyalty survived longer than the system that had rewarded it. Workers continued behaving as though tenure itself guaranteed increasing economic value. Employers no longer had the same obligation to make that true. By January 2024, the median American wage and salary worker had been with the same employer for only 3.9 years. The labor market had already changed. The psychology often had not. Consider a worker who remains in the same position because leaving feels risky. A 3% raise feels like progress. Nominally, IT is. But salary growth does not compete only against last year's salary. It competes against inflation, market wages, opportunity cost, and the value of skills that may be depreciating while the worker remains comfortable. This is why job switching can create a wage advantage. That does not mean changing jobs is automatically profitable. It means loyalty has no automatic financial premium. When an employee spends years accepting below-market compensation, the loss is not simply the missing salary. Every future percentage raise starts from a smaller base. Retirement contributions tied to salary start from that smaller base. Employer matches tied to compensation do the same. The loss compounds. A worker does not merely lose $5,000 in year one. He can lower the trajectory from which the next 20 years are calculated. That is the mechanism, and it leads directly to the second decision: changing jobs for salary alone. This appears to contradict the first point. It does not. The opposite mistake can be equally expensive. Imagine 2 job offers. One pays $110,000, the other pays $103,000. Most people instinctively identify the first as the better financial offer. But salary is only one line on a much larger balance sheet. The second employer might offer a stronger retirement match, lower health insurance premiums, better disability coverage, more paid leave, profit sharing, or equity. The first might offer almost none of it. The worker sees $7,000. The system sees total compensation. This distinction became more important as retirement responsibility moved from institutions toward individuals. A 401k, employer contribution, is compensation. Health insurance subsidies are compensation. Paid leave is compensation. Equity is compensation. Vesting is compensation. But because these benefits do not always appear in the amount deposited into a checking account every 2 weeks, workers can underestimate them. This is where the arithmetic becomes deceptive. Suppose an employer matches retirement contributions. A worker who ignores that match to maximize take-home pay is not simply choosing to save less. He may be declining compensation. The lost amount does not disappear once. It disappears along with the future growth that money could have generated. A career decision made at 32 can still affect an account balance at 62. The third decision is even quieter. Leaving before the money belongs to you. Modern compensation often contains a delayed ownership mechanism called vesting. A company may place money into a retirement plan, award stock, or grant restricted shares. But seeing an asset on a statement does not necessarily mean you legally own all of it. Ownership may accumulate over time. Leave too early, and some of it can disappear. This creates a hidden exit cost. Imagine receiving an offer that increases salary by $12,000. It looks obvious. Then you discover that another 6 months at your current employer would vest $20,000 of employer contributions or equity. Suddenly, the raise is not the entire decision. Timing is. The worker who leaves without calculating vesting may spend years earning back money surrendered on the day of resignation. Employers understand something workers sometimes ignore. Time has financial value. Vesting schedules convert that time into a retention mechanism. The fourth decision is repeatedly resetting retirement savings when changing jobs. The modern worker changes employers more. Easily then retirement accounts change identities. One 401k becomes two, then three. Eventually the accounts become administrative debris. One gets forgotten, another sits in an expensive plan, another gets cashed out because its balance looks small. That last decision is particularly important. A retirement balance of $8,000 or $15,000 may not look life-changing. But retirement mathematics does not care whether an account feels small today. It cares how much time remains. Money removed at 30 does not merely remove the principal. It removes decades of potential compounding. A career transition becomes a wealth interruption. There is another subtle effect. A worker changes jobs, receives a meaningful raise, and feels wealthier. Consumption rises. Retirement contributions do not rise proportionately. The paycheck improved, but the percentage being converted into ownership declined. The career advanced. The balance sheet did not advance at the same rate. This is where it breaks. The fifth decision is allowing lifestyle to rise automatically with title. A promotion is usually treated as an unambiguous financial victory, but a promotion changes more than income. It can change the social environment surrounding the worker. Different colleagues, different neighborhoods, different cars, different restaurants, different expectations about clothing, travel, housing, schools, and status. On a household balance sheet, the mechanism is simple. The worker receives additional income and converts too much of it into permanent recurring expense. This matters because income is reversible. Expenses often are not. A bonus can disappear next year. A mortgage payment remains. A promotion can be lost. Tuition remains. A high-paying industry can contract. The financed vehicle remains. The worker has converted volatile labor income into fixed obligations. Once fixed costs become large enough, those obligations begin influencing career behavior. The employee cannot easily tolerate unemployment. Retraining becomes harder. Leaving a destructive employer becomes harder. Accepting a temporary pay cut for a better long-term opportunity becomes harder. The lifestyle that was supposed to demonstrate career success begins controlling the career itself. This mechanism is older than modern corporate life. Rising income has always produced pressure to signal rising status. What changed is the ease with which those signals can be financed. Housing, vehicles, education, travel, and consumption can all be purchased using future income. The worker, therefore, does not merely spend today's raise. He can commit tomorrow's salary before earning it. That is the hidden constraint. A high salary with low fixed expenses creates options. A higher salary with enormous fixed expenses can create dependence. The sixth decision is buying credentials without calculating their economic return. Education is one of the clearest examples of how averages can conceal mechanisms. On average, education pays. Workers with bachelor's degrees earn substantially more than workers whose highest credential is a high school diploma. But averages do not mean every degree produces the same return. The category college graduate contains radically different debt loads, institutions, majors, completion rates, and labor market outcomes. Two people can both hold graduate degrees while experiencing completely different financial consequences. A credential, therefore, has at least two prices. The obvious price is tuition. The less obvious price is time. Years spent outside full-time earnings can mean years without salary growth, retirement contributions, employer matching, and professional experience. Debt may accumulate during the same period. A $70,000 graduate program is therefore not merely a $70,000 purchase. Its economic cost can include financing costs plus whatever income and compounding were sacrificed while acquiring it. This does not make education irrational. It makes unpriced education irrational. For much of history, education functioned partly as intellectual development, professional qualification, and social status. In the modern credit economy, it can also function like a leveraged financial asset, and leveraged assets require cash flow. If the credential does not increase earning power enough to justify its total cost, the worker has not necessarily purchased mobility. He may have purchased an obligation. The seventh decision is specializing until your salary becomes a trap. Specialization usually increases income. That is why modern economies reward it. Someone who can perform a rare and valuable task can command more money than someone with interchangeable skills. But extreme specialization creates concentration risk. A worker can become extraordinarily valuable to one industry, one technology, one regulatory structure, or even one employer. Then the environment changes. History is filled with occupations that looked durable until the economic structure beneath them shifted. Manufacturing communities experienced it during deindustrialization. Clerical workers experienced it during computerization. Print workers experienced it during digitization. Entire regional economies changed when factories moved. Mines closed or major contracts disappeared. The error was not specialization. The error was confusing today's scarcity with permanent scarcity. A salary is a market price. Market prices change. The more a household's financial survival depends on one highly specific stream of labor income, the more exposed it becomes to structural change. And unlike a financial portfolio, human capital cannot always be reallocated overnight. A 48-year-old specialist cannot necessarily become a different specialist on Monday. Retraining takes time. Building credibility takes time. Replacing seniority takes time. In some industries, starting over also means accepting lower compensation precisely when household obligations are at their highest. The constraint is not intelligence, it is time. This is why career resilience and maximum salary are not always the same objective. A worker can maximize today's paycheck while simultaneously increasing exposure to tomorrow's labor market changes. The eighth decision is ignoring fees because they look too small to matter. This appears to be an investment issue. It is also a career issue because millions of workers encounter investment costs through employer retirement plans. 1% looks microscopic. Over decades, it is not. Consider the example used by the U.S. Department of Labor. A worker has $25,000 in a 401k, 35 years until retirement, and investments averaging 7% before fees. If fees reduce average returns by 0.5 percentage points, the account grows to roughly $227,000 without additional contributions. If fees reduce returns by 1.5 percentage points, the balance reaches only about $163,000. The difference in annual fees is 1 percentage point. The difference in ending wealth is roughly 28%. Nothing dramatic happens in any single year. There is no crash, no fraud, no frightening headline. The money simply compounds at a slightly slower rate for 35 years. That is what makes recurring costs so powerful. Human intuition notices large immediate losses. It is much worse at detecting small mathematical drags repeated for decades. A worker can negotiate aggressively for a $5,000 raise while ignoring a retirement structure capable of consuming far more over an entire career. The ninth decision is stepping out of the workforce without calculating the full cost. Sometimes leaving work is unavoidable. Children need care, parents become ill, families relocate, layoffs happen. The mistake is not the interruption itself. The mistake is measuring its financial cost only as the salary that disappears. A year outside the workforce can affect several systems simultaneously. There is the lost salary, the employer retirement contribution that was never made, the employee contribution that never entered the account, and the investment growth those contributions never earned. Then there is lost skill progression, delayed promotions, and the possibility of returning at a lower wage. Future raises may also begin from that lower base. In the United States, another mechanism reaches even further into the future. Social Security retirement benefits are based on a worker's highest 35 years of earnings. If fewer than 35 years contain earnings, 0 earning years can enter the calculation. Even a worker with 35 years may improve the calculation by replacing earlier low earning years with later higher earning ones. A year without earnings may appear to end on December 31st. Financially, part of it can survive for decades. Again, that does not mean nobody should leave work. It means the real price of leaving is larger than the missing paycheck, career. Interruptions demonstrate the same pattern that appears throughout this system. The immediate number is visible. The long-term opportunity cost is not. And now we arrive at the 10th decision, the one that connects all the others, optimizing your career for income instead of ownership. This is the central mistake. For most workers, often the first decades of adult life are dominated by income questions. What does the job pay? What is the raise? What is the bonus? What is the next title? What is the hourly rate? These are rational questions. But wealth operates through a different system. Income is a flow. Wealth is a stock. A person can earn a large flow for decades and still accumulate a surprisingly small stock if that flow continuously exits through taxes, debt service, consumption, fees, housing costs, and lifestyle expansion. This is why two people with similar lifetime earnings can arrive at retirement in radically different financial conditions. One converted a meaningful share of labor income into assets. The other converted most of it into consumption and obligations. Their resumes may look similar. Their balance sheets do not. And this is not merely a story about personal discipline. It is historical. After the Second World War, the American employment bargain was built around institutions that absorbed part of the worker's long-term financial risk. Defined benefit pensions transferred much of the investment and longevity risk toward employers. Long employment relationships created incentives for tenure. Employer health insurance became deeply embedded in compensation. Social Security provided another layer beneath retirement income. Over time, parts of that architecture changed. The 401k did not simply create another retirement account. It transferred decisions. How much should be contributed? Where should the money be invested? What happens when the worker changes employers? Should the account be rolled over or cashed out? How much in fees is acceptable? How much risk should be taken? The worker became the pension manager, but most workers were never trained as pension managers. At the same time, careers became more mobile. Median employee tenure reached 3.9 years in January 2024. The labor market became increasingly transactional, while many financial benefits remained complicated, delayed, and tied to employment. That created the modern career trap. Workers are encouraged to move, but moving can interrupt retirement saving. They are encouraged to earn more, but higher income can create higher fixed expenses. They are encouraged to specialize, but specialization can concentrate labor market risk. They are encouraged to obtain credentials, but credentials can require debt. They are encouraged to pursue salary, but salary does not measure total compensation. And they are encouraged to prepare for retirement, even as much of the responsibility for doing so has shifted directly onto them. None of these mechanisms requires conspiracy. They emerge from incentives. Employers want flexibility. Workers want higher income. Universities sell credentials. Lenders finance them. Retirement providers administer accounts. Consumers increase spending when income rises. Every participant can behave rationally within narrow incentives, while the worker's long-term balance sheet deteriorates. That is what makes the system difficult to see. There is rarely one catastrophic decision. Instead, there are dozens of reasonable ones: a slightly underfunded retirement account, a slightly expensive fund, a promotion followed by a larger house, a degree financed with debt, a job change shortly before vesting, a retirement account cashed out between employers, years spent below market salary, time outside the workforce, or a highly paid specialization that becomes less valuable. Each decision appears survivable. Most are, but net worth is cumulative. It records everything. At this point, the irreversible constraint becomes clear. A career has limited years. A 35-year-old can replace lost money. A 45-year-old can still replace lost money. A 55-year-old can replace some lost money, but no worker can purchase another decade of compounding at 65. Time cannot be refinanced. It cannot be negotiated with an employer. It cannot be recovered with a promotion. Once a year passes without saving, earning, or building ownership, that year is gone. That is the trap. History offers an important contrast. The 20th century worker often feared losing the company pension. The 21st century worker faces a different problem. He may never have a traditional pension to lose. Instead, he carries a collection of individually managed risks from employer to employer. The responsibility is fragmented. One company determines salary. A retirement provider administers the account. An insurer controls part of the healthcare economics. A university may have created the debt. Government rules determine taxes and Social Security. The worker sits in the middle. And because no single institution sees the entire household balance sheet, no institution is responsible for optimizing it. Only the worker sees the whole system, or doesn't. That is why the most expensive career decision may not be choosing the wrong profession. It may be misunderstanding what a career is financially designed to do. A career produces labor income. It does not automatically produce wealth. The conversion has to happen somewhere. Income has to become ownership. If that conversion is interrupted repeatedly for 30 or 40 years, the final number can remain surprisingly small regardless of how impressive the career looked from the outside. Return to that parking lot. You are 44. You have worked for 22 years. The question is no longer simply how much you earn. It is how much of those 22 years still belongs to you. How much exists as equity and retirement assets? How much of your compensation actually vested? How much disappeared through recurring costs? How much future income is already committed to fixed expenses? How dependent is your earning power on one company, industry, or specialized skill? Those are not merely investment questions. They are career questions. The modern labor market hides them because salary is visible and opportunity cost is not. A paycheck arrives every 2 weeks. Loss compounding never sends a statement. A raise appears immediately. The cost of staying too long appears gradually. A new title becomes public. Foregone wealth remains invisible. That asymmetry explains why intelligent, highly paid people can spend decades advancing professionally while advancing far less financially. The system rewards the appearance of progress immediately. Net worth records the consequences later. This is historical and educational analysis, not financial or investment advice. This channel studies the systems behind outcomes most people notice only after the consequences become visible. Career wealth follows the same pattern. The decisions that damage it most rarely look reckless when they are made. They can arrive as promotions, larger salaries, impressive credentials, and better titles. The balance sheet does not recognize any of those symbols. It records the arithmetic. And by the time that arithmetic becomes impossible to ignore, the one asset no worker can replace has already been spent: time.